Most people won't hear this until it's already happened to them, so let me start here. Calmly and clearly, millions of Americans are about to wake up one morning, open their banking app, and realize their credit card no longer works the way it used to. Not because they missed a payment yesterday, not because they maxed it out overnight, but because the system quietly decided they were no longer worth extending trust to, and that moment is going to feel confusing, unfair, and sudden, even though the warning signs have been there for years. Here's the truth most banks aren't explaining clearly. Credit card access in America has never been about loyalty, effort, or even how hard you work. It's about risk models, behavior patterns, and silent thresholds that most people don't even know exist. And right now, those models are changing fast. Picture a normal American household. Maybe it looks like yours. Rent or mortgage eating up 35-45% of income, a car payment around $450 a month, groceries quietly creeping past $800, subscriptions you barely remember signing up for, and one or two credit cards carrying balances that never quite hit zero. Nothing dramatic, nothing that feels reckless, just normal. And that's exactly the problem, because what feels normal to you looks dangerous to a bank's algorithm. For years, credit was cheap, approvals were loose, limits kept rising, and people were trained to believe that having access to credit meant stability, even maturity. But now inflation has squeezed margins, defaults are ticking up, and banks are pulling back, not loudly, not with press conferences, but surgically, line by line, account by account. Let me be clear, this isn't about punishing people who are irresponsible. It's about removing exposure to people who are predictable spenders, predictable revolvers, predictable paycheck-to-paycheck users who rely on credit cards to smooth out a life that no longer fits their income. And the most dangerous part is this: you won't get a clear explanation. You'll get a generic email about account review, a notice about updated terms, maybe a reduced credit limit, maybe a closed account for inactivity, even though you used it last month. And you'll be left asking yourself what you did wrong when the real answer is that the environment changed and you didn't. Most Americans don't realize how fragile their credit access actually is. Because it worked yesterday, it worked last week, it worked last year, so the assumption is that it will keep working tomorrow, but credit doesn't operate on assumptions, it operates on forward-looking fear. Banks don't ask, has this person survived so far? They ask, if conditions get worse, will this person break? And right now, with interest rates high, savings low, and consumer debt sitting at historic levels, that question is being answered very aggressively. Think about what happens emotionally when credit disappears. It's not just about convenience, it's the grocery run that suddenly requires math. It's the car repair that turns into a crisis. It's the flight you can't book for a family emergency. Credit cards have quietly become the shock absorbers of American life, and when those shock absorbers are removed, every bump hits harder. This is where people get trapped, because instead of stepping back and reassessing, panic sets in. Applications go out to other lenders, hard inquiries stack up, utilization spikes, scores dip, and suddenly the very behavior meant to fix the problem accelerates the collapse. And the banks see that too. They see the desperation patterns. They see the late-night balance transfers, the cash advances, the minimum payments that barely touch principal, and they flag accounts not because of a single mistake, but because of a story. A story that says, this person is running out of room. Here's the uncomfortable part you may be avoiding. If your lifestyle requires credit to feel stable, you are already in a fragile position, even if nothing is broken yet. That doesn't mean you're lazy or careless, it means the system trained you to stretch, to normalize carrying debt, to treat future income as a solution for present discomfort, and now that future is arriving with fewer guarantees. Visualize yourself 5 years from now if nothing changes, still working, still paying, still revolving balances at 22% interest, still hoping for raises that barely beat inflation, and ask yourself honestly whether that version of you feels calm or trapped, because that's the version the banks are modeling right now. They're not judging your intentions, they're judging trajectories. And trajectories don't care about motivation, they care about math. A $6,000 balance at high interest doesn't feel deadly month to month, but over years it quietly drains options, energy, confidence, and when combined with rising rent, medical costs, or a single job disruption, it becomes the tipping point that credit models are designed to avoid. This is why access is being tightened at the edges first. People with mid-range scores, inconsistent utilization, modest savings, because that's where risk concentrates under stress. And the silence is intentional. If banks explained this clearly, people would panic, markets would react, and behavior would shift abruptly. So instead, the messaging stays vague, procedural, sanitized. Routine review, portfolio adjustment. Words that hide the reality that the era of easy credit is ending for a large portion of the population, and the people most affected will be the ones who thought they were doing everything right. Here's another truth most people don't want to hear. Your credit score is not a moral grade, but your habits are being interpreted morally by a system that doesn't care about context. It doesn't care that groceries are more expensive. It doesn't care that wages lagged. It doesn't care that student loans restarted. It only sees ratios, timing, consistency, and stress signals. And once those signals cross invisible lines, access disappears. Not gradually, but decisively. Imagine checking out at a store and seeing declined, not because you're broke, but because your limit was reduced overnight. Imagine calling customer service and hearing polite scripts instead of solutions. That moment changes how you see money forever. And here's where urgency matters. Because this isn't a future problem, it's already happening quietly, account by account, and most people won't react until it hits them personally. Awareness is the turning point, not panic, not shame, awareness. Seeing credit not as a safety net, but as a temporary tool that can be taken away without notice. Seeing debt not as neutral, but as a claim on your future flexibility. Seeing that the system rewards those who look boring, stable, low risk, even if that stability comes from restraint rather than income. This is where an identity shift begins, from reactive to intentional, from assuming access to earning leverage through discipline. But before that shift can happen, you have to confront the uncomfortable question most Americans avoid. If credit tightened tomorrow, would your life still function, or would it fracture? Sit with that question, because in part 2, we're going to walk through what separating your stability from credit actually looks like, why most people resist it until it's too late, and how the quiet decisions you make in the next few months could determine whether you stay in control or become another silent statistic the banks never explain, only act on. If you're still here, it's because something in part 1 landed heavier than you expected. Not fear, not panic, but recognition. That quiet realization that this isn't about other people losing access, it's about a system that no longer rewards drifting. And part 2 is where that realization has to turn into something sharper, because awareness without action just becomes another form of regret. Let me be clear about what separating your stability from credit actually means, because this is where most Americans misunderstand the solution and either overreact or do nothing at all. This is not about cutting up every card tomorrow, living on ramen, or pretending the system doesn't exist. It's about understanding leverage, who controls it, and why the person with the calmest financial life is usually the one who needs credit the least. Think about how banks define safety. Predictable income, low utilization, cash buffers, boring behavior. Notice how none of that sounds impressive or exciting, yet that's exactly what keeps doors open. The problem is that modern American life quietly trains you in the opposite direction, to optimize for convenience, speed, and comfort now, while assuming you'll figure it out later, and later keeps getting more expensive. Here's a reality most people don't confront until they're forced to. Credit doesn't create stability. It masks instability. It smooths over gaps, delays consequences, and gives the illusion of control until the moment it's withdrawn, and then the underlying structure is exposed. That's why the first internal shift has nothing to do with money and everything to do with identity. You stop seeing yourself as someone who manages bills and start seeing yourself as someone who manages risk. That's a different mindset entirely. Managing bills is reactive. Managing risk is intentional. One waits for statements, the other plans for disruption. Picture two people earning the same $65,000 a year. One uses credit to float expenses, pays minimums, hopes nothing goes wrong. The other builds friction into their life, lower spending ceilings, fewer obligations, a small but real cash reserve, not impressive, just functional. On paper, they look similar. Under stress, they are not. When a credit line gets reduced, one panics, the other adjusts. This is the gap banks are pricing right now. And here's the part that stings. Closing that gap doesn't require a massive income jump. It requires facing habits you've been avoiding because they don't feel urgent, until suddenly they are. Start with utilization, because this is one of those silent killers people underestimate. Carrying 40-60% balances across cards feels manageable until it isn't. And banks read that as dependency, not responsibility. Lowering utilization isn't about gaming a score, it's about signaling optionality, that you're choosing to use credit, not leaning on it. Then there's cash, which people either romanticize or ignore. No, an emergency fund won't fix everything, but even 1 month of real expenses fundamentally changes how you think, because now a surprise doesn't immediately threaten your identity. That psychological shift alone alters behavior in ways algorithms pick up over time. And yes, this means saying no to things that feel normal, upgrades, convenient spending, lifestyle inflation that quietly crept in while no one was watching. This is where guilt shows up, not the toxic kind, but the clarifying kind. The realization that money you once spent casually now represents future freedom you delayed. Sit with that. Don't numb it. That discomfort is recalibration. Now visualize the future consequences on both paths. One version of you keeps drifting, telling yourself you'll address it later, hoping rates come down, hoping limits stay intact, hoping income rises faster than costs. 5 years pass quickly. The other version makes unglamorous changes now, fewer obligations, tighter systems, less reliance. 5 years pass the same amount of time, but the outcomes are radically different. One feels boxed in, the other feels choice. That's the compounding no one talks about, not just dollars, but decision power. This is where pride should activate, not ego, pride in restraint, in control, in becoming someone who doesn't flinch when conditions tighten. Because here's another uncomfortable truth, volatility isn't going away. Inflation may slow, rates may shift, but uncertainty is now a permanent feature of the landscape. The people who suffer aren't the ones with the lowest incomes, they're the ones with the highest fixed commitments relative to flexibility. This is why simplifying your financial life is not a step backward, it's a strategic move forward. Fewer accounts to manage, fewer balances to juggle, fewer monthly obligations competing for attention. Simplicity isn't minimalism, it's resilience. And let me address the fear directly, because it's there even if you don't name it, the fear that without credit you'll fall behind, look unsuccessful, miss out. That fear is manufactured. Real respect, internal and external, comes from someone who doesn't need to prove stability through spending. It comes from consistency, from being the person who handles problems quietly, without drama. This is where the identity shift locks in. You stop chasing relief and start building capacity. You stop reacting to statements and start designing margins. You stop assuming access and start earning leverage. And leverage, real leverage, isn't borrowed money, it's options. Options come from cash flow control, low obligations, and the ability to wait. Waiting is power in a system built to rush you. Now imagine waking up 6 months from now knowing that if a card closes, your life doesn't unravel. That calm changes how you negotiate, how you work, how you plan. You're no longer operating from fear of loss, but from clarity. That's not hype. That's math plus psychology working together. And this is the final push, not a call to hustle or grind, but a call to stop avoiding the quiet work that actually determines outcomes. Review what you owe. Reduce what you can. Build buffers slowly. Treat credit as optional, not foundational, because the banks are already adjusting. The only question left is whether you will adjust before they force you to. This isn't about beating the system. It's about no longer being fragile inside it. And if this moment feels heavy, good. Heavy moments are where real change starts. Not tomorrow, not when something breaks. Now, while you still have choices,